Hi, and welcome to the Stockscores Market Minutes for May 17th, 2013. This week's topic, the profit, is in the patience. You know, normal people tend to doubt strength. We have been conditioned to think that all good things must eventually come to an end. The result is that we tend to sell our winners early, particularly if these winners are exceptionally strong. Now, this problem is compounded by the experience of the last 13 years, which has seen sharp corrections, causing traders to fear reversals. You must remember that there is really no limit to how high stocks can go, and we shouldn't doubt strength, but instead embrace it until strength begins to turn to weakness. Sell when the market tells you to sell, not when your fear causes you to run for the exit door. Now, there's a great example of this in my trading from yesterday. I picked up this stock very near the open, a stock that was strong at the open. It gapped up slightly, was trading much more volume than normal. And as the day wore on, I kept wondering, when is this thing going to end? By the end of the day, the stock had grown 100% from its opening price, actually more than 100%. And that is, in many cases, what many people would believe is impossible, and yet this stock did it. Now, if I had sold simply because it felt good at maybe a 30% profit or a 40% profit, I would have left a lot of money on the table because this stock never broke its upward trend line. It just kept right on marching higher. And particularly with day trades like this, I often find that it's better to buy your positions in the morning and then hold them until the afternoon, until the close, because that way you can stick with that trend on the hottest of hot stocks. All right, here is the charts for this week. This is the chart of the S&P 500, an upward sloping channel, a very bullish trend. My only concern with this chart is that the trend is going parabolic. You can see that we have broken through the top of the channel, and that is a cautionary sign because trends that go parabolic eventually correct back into the trend. Now, with that said, there is no sign of weakness here. I would continue to be bullish on this market, bullish on US stocks, particularly the large cap dividend paying stocks. But just remember that eventually these parties end and we don't want to be the one left holding the bag. The Toronto Stock Exchange has been a real underperformer this year, but it made a pretty good show of things on Friday, breaking from a flag pattern. I've drawn the flag there in red, and that tells me that this market is likely to now move up towards resistance at 1870 on the TSX 60 ETF. So keep an eye on that. But again, this market continues to underperform. The only areas of strength are in the large cap dividend paying stocks on the TSX. Generally speaking, the commodity stocks are still looking pretty weak. The Treasury Bond ETF, TLT, I've actually drawn here a 3-year weekly chart because I want to highlight the cup and handle, or pardon me, the head and shoulders top that is forming on this pattern, or pardon me, this ETF. And that could lead to higher interest rate yields. If this starts to go down, of course, that means yields go up. Look for a break of that neckline, as I've drawn in green, that break from a falling top. Now, again, it hasn't happened yet, but it is something to watch for in the weeks to come. Gold had a terrible week again this week, which is okay if you are short gold or long some of the ETFs that go up when gold goes down, as I am. The chart is coming into some support here, probably stalls its downward move this coming week simply because it is at support, maybe moves back to that steepest of downward trend lines, but there's no reason to be buying gold here. I think maybe unless there's a little bounce, other than that, the weakness is likely to continue. And on oil, we're at a critical point because we've rallied into resistance and the volatility in oil is narrowing. You can see that I've got a green line drawn across the bottoms and a red line drawn across the tops, and those lines are converging towards one another. That means that volatility is condensing. And the reason that that's important is because we tend to get the biggest breaks in terms of trend out of low volatility. So what you want to watch for on oil is a break either of the red line or of the green line. If we break down below the green line, then oil is likely headed lower. If we break up through the red line, then oil is likely headed higher. The most likely outcome, given the long-term falling tops on oil, is that we will break to the downside, but I do like to wait for the break before I make that prediction. And my final chart this week is of the fear index, the VIX. VXX is the ETF. And you can see I've made this chart a very short-term one simply because the long-term trend is so long that it really takes the scale out of things on the right-hand side of the chart. But here you can see that we are breaking through support yet again. And this shows us that the market really is complacent, doesn't have a lot of fear. And that's a good sign for stocks, but it's also a sign that we could be setting up for a reversal in the market. Again, I don't see any sign of that yet, but just that's close to the exit door. So I am bullish on US stocks, neutral on Canadian. I do think in the short term, however, the Canadian market is going to go higher. And I also think that the bullish US market is getting a little overbought and is risky. Gold bearish and oil neutral. US stocks continue to look strong and risky. The Canadian market appears likely to gain in the near term. Gold is ugly, but getting oversold and nearing a bounce back. Oil is approaching a critical turning point. Watch for an abnormal break to telegraph the next trend. Well, that has been the Stockscores Market Minutes for May 17th, 2013. Have a great week in the market and trade well.